Hello friends, I welcome you all on my YouTube channel. I am recording this video to explain you the procedure to be followed for the computation of total taxable income of the partnership firm, and along with this procedure I will also explain the procedure to be followed to compute the total tax or the final tax liability on the total taxable income of the partnership firm. And all these calculations I will do according to the provisions prescribed in the new Income Tax Act 2025 for the assessment of partnership firm. So this problem I have already shared with you on Google Classroom. So I request you all to keep the copy of this problem along with the notes, and if possible keep few loose papers, and while I am solving this problem, you also solve the problem with me with the pace of video. But before that, it is necessary to read the entire problem one more time along with its adjustments. So kindly pause the video, give yourself few minutes, and read in detail the entire problem. So first, read in detail the profit loss account for the year ending 31st March 2027, and after that read in detail all the adjustments. And after reading the adjustments, if it is possible for you, then kindly mark the accounting items provided in the profit loss account. I mean to say, for example, so this is the adjustment number 3, and our adjustment number 3 is related to office expenses. So use your pencil and find out first office expenses. For example, office expenses are recorded over here. So here, if it is possible, then mention 3. So 3 means what? 3 is connected with adjustment number 3 is connected with this accounting item office expenses. Okay, and do the same, or provide the same treatment. Provide the same treatment for all important particulars provided in the profit loss account. If they are connected with the adjustments, then please mention over there the adjustment number, and follow this procedure or follow this step for each and every problem from here onwards, whether it is of accounting or tax or costing or financial management. Follow this practice for every problem. Okay, now let's begin with the solution. So this is the format for the computation of total income and tax liability of the partnership firm, and the tax year is 2627. So this is the title, this is the opening title. So here first we will find out the book profit, and to find out the book profit, we have prepared this I have prepared this table, and we all will prepare the same table. And this is the by the way, this is step number 1. So in step number 1, compute the book profit, partnership firm's book profit. Now what is the need to compute the book profit? Answer is very simple. Because in order to calculate the allowable partner remuneration, so how much remuneration should be paid to partners according to income tax provision, the required figure is book profit. So for the computation of allowable partners remuneration, the figure which we will use is the figure of book profit. So we will find out first book profit. So this is the table for the computation of a book profit. So in this table here, first we will mention the figure of net profit as per profit and loss account. So here the problem, so the figure of net profit is 93 lakhs 22,800. Then we will begin our solution with this figure only. So 93 lakhs 22,800 in the third column. In the column of amount, I have mentioned this figure 93 lakhs 22,800. Now the next thing or next step is to add all disallowed expenses which are debited to profit loss account, and technically all these expenses shouldn't be recorded at the debit side of profit loss account. Means what? Means I mean to say, the expenses which are not partnership firm's business expenses, shouldn't be recorded on the debit side of profit loss account. And as they are recorded on the debit side of profit loss account, they are decreasing the amount of profit. I mean to say, for example, let's say the personal expenses of partners. Now, personal expenses of partners shouldn't be recorded as a business expenses, in the partnership's profit loss account, because these are non-business expenses, and non-business expenses are disallowed expenses, and all these expenses should be added back again in the net profit to find out partnership firm's book profit. So in short, check the debit side of profit loss account, identify non-business expenses which are recorded over there, add them back again in the net profit to find out the book profit. Okay, so now we will check the debit side of profit loss account. So the first particular, or rather what we will do, few things are very clear to calculate the book profit. I mean to say, first add back all partners remuneration. And remuneration means what? Remuneration means salary, then bonus, and commission. If salary is paid to partners, if commission is paid to them, if bonus is paid to them, add back all these together in the net profit. So salary to Ram, and Ram, by the way, is a working partner. So amount is 20 lakhs. Salary to Sham is also working partner. Amount is 30 lakhs. Subhadra, salary paid to Subhadra. She is non-working partner, and amount is 5 lakh. Commission paid to Ram, and bonus paid to Sham. Make a total of all these figures. I think the addition is 50, 20 plus 30, 50, 55, 57, 58. So add back all remuneration paid to partners together again in the net profit. So 58 lakhs. Added back to find out book profit. Next thing to be added is excess interest on capital. See, as far as provision is concerned, so income tax means new income tax allows deduction up to 12%. 12% interest on partner's capital. But any interest paid in excess of 12% is disallowed, and it should be added back again in the net profit to find out book profit. So any interest in excess of 12%, if it is given to any partner, then it should be added back again. Okay, now see here, I think next point, here Ram interest is paid on capital at the rate of 12%, and which is validly allowed, because up to 12% interest deductions partnership firm can claim. But any interest paid above 12%, it cannot be, means partnership firm cannot claim any interest in excess of 12% as a business expense. So here Ram has been paid interest on his capital at the rate of 12%, which is perfectly fine, no doubt, no problem. But in case of Sham, interest is paid on his capital at the rate of 18%, and up to 12% interest is allowed. It means it can be shown as a business expenditure, but any interest in excess of 12% cannot be claimed as a business expenditure, and it should be added back. So technically, I'll show you the calculation. So here, let's say S for Sham, SH for Sham, then he has been paid interest at the rate of 18%, and at the rate of 18%, he has been paid 1,80,000 rupees. 1,80,000 rupees, whereas interest up to 12% can be claimed as a business expenditure, but any interest in excess of 12%. So in this case, he has been paid excess interest at the rate of 6%. So that much portion cannot be claimed as a business expenditure, and it should be added back in the net profit to find out the book profit. So here simply, in order to find out the corresponding portion related to 6%, we need to do the cross multiplication. I mean to say, multiply 6 by 1,80,000, 1,80,000, then divide it by the total interest rate, that is 18 percentage. We will get the uh, we will get the figure corresponding to excess percentage, excess percentage interest, that is rupees 60,000. So out of 1,80,000, 60,000 is the amount of interest which is paid extra and which is completely disallowed. Oh, okay. So this is the calculation for Sham. In the same way, we will do the calculation for Subhadra also, because Subhadra has been paid interest at the rate of 27 percentage per annum, and in total she received 2,70,000 from the partnership firm as an interest on her capital. So she is also paid. So SU for Subhadra, she has been given interest at the rate of 27%, and the total amount is 2,70,000. 2,70,000, whereas any interest in excess of 12%. So here you deduct 12 from 27, you will get a figure of 15, and 15 is the additional interest paid over the allowed interest mark, that is 12%. So that much portion should be disallowed and should be added back. So again do the cross multiplication. So for that, multiply 15 by 2,70,000 and divide the same by 27 percentage. So the corresponding portion of interest is 1,50,000. So it means if you add this 1,50,000 with this 60,000, then you will get the figure of excess interest paid on capital. So the total is 22 lakh 10,000. So this 2,10,000 is the excess interest paid on capital, and it should be added back. That's why we added back again the excess interest paid on capital. Okay, now next thing in the problem. So the first particular in the problem is office expenses, and we know that the adjustment number 3, this adjustment. So as far as this adjustment is concerned, the total office expenses includes 20,000, which are disallowed. Which are disallowed means what? These 20,000 are not business expenditures, and this 20,000 shouldn't be recorded on the debit side of profit loss account. So, as these are already shown there, we will add it back again in the net profit to find out the book profit. So, here office expenses, I think I have recorded these office expenses here in this row, but you can mention the same as a point number 3, no problem. Okay. Now the next in the problem is so this is done. The next in the problem is staff salaries and wages, and the figure is 30 lakhs. I think staff salaries and wages technically are business expenses, but let's see whether there is adjustment any related to staff salaries and wages. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. None of the adjustment is connected with this staff salaries and wages, and this is pure business expenditure. So this is not non business expenditure, so don't do anything. Now the next thing is traveling expenses, and total is 5 lakh. So let's find out whether there is any adjustment. So traveling adjustment number 6. Look, the total traveling expenses in the problem I think are rupees 5 lakh. Okay, but here as according to adjustment number 6, this 5 lakhs includes rupees 8,000, which are personal in nature, and personal expenses cannot be shown as business expenses. That's why act disallow the deduction of this expense in the profit loss account. So it should be added back again in the net profit to find out the book profit. So uh, traveling expenses where I've shown, okay, I have shown traveling expenses here in this, in the row number 11, in the row number 83, point number 11. Okay. Now the next point in the problem is, I think we have already done, we have already provided the effects for salaries, remuneration, then interest. Next is depreciation as per book. So in the profit loss account, depreciations deduction is taken for a value of rupees 2 lakhs, but I think there is an adjustment. The adjustment number is 8, And as per income tax rules, the depreciation can be claimed up to rupees 1,90,000. So whenever you will find a mismatch in the depreciation figures, that time for a better tax treatment, do one thing. So whatever deduction is claimed in profit loss account. So here in the problem it is claimed up to rupees 2 lakhs. So add it back again in the net profit, and at the same time we know the deductions can be claimed for depreciation is rupees 1,90,000. So here in the same table, below allowable business expenses, deduct rupees 1,90,000 because it is verified by tax rules. The verified figure is 1,90,000. Okay. Now this adjustment is also over. I'll just tick it. Okay, I already ticked it. Okay. Now the next thing in the problem is municipal tax of house property. So, and here in the bracket, what is mentioned? Entire property. So, it means on entire property, this firm has paid 6,000 rupees as a municipal tax. But the question is this firm using entire property for running business? This is the question. I am repeating the question. Is this partnership firm using this house property for running its partnership business? The answer is no. Why? Because there is an adjustment. Adjustment number, yes, number 9. And according to adjustment number 9, this firm using ground floor for business purpose, and first floor and second floor is given on a rent. And by the way, giving property on a rent is not the core business of a partnership firm. It is a secondary income source. And here we are doing computation for total taxable income and tax liability on your total taxable income. And we all know there are few heads of incomes like income from salary, income from business profession, income from house property, income from other sources, income from capital gain. And here they have let out this property, that is house, and on the after letting it out they are receiving rent. So this rent is no doubt, this rent is the income of the firm, but it cannot be shown as a income from business and profession. It cannot be shown under the head PGBP, that is profits and gains from business and profession. We can show it under the head income from house property, this rent figure. So accordingly, as this firm using only ground floor for business purpose, and here as a expenditure, total municipal tax paid is rupees 6,000. So technically, this 6,000 should be divided into three parts, because part one, that is ground floor, is used for business, and the first floor and second floor, it means 2/3 part is let out property. So out of this 6,000, only 1/3 can be shown as a business expenditure, but 2/3 part cannot be shown as a business expenditure. So simply divide this 6,000 by 3, then valid portion which can be shown as a business expenditure is rupees only 2,000, but remaining 4,000 cannot be shown as a business expenditure. So that should be disallowed and that should be added back in the net profit to determine the book profit. So here I have shown the calculations. So disallowed part is 2/3 because that is let out portion, and that much expenditure we can claim. So that 4,000 as a expenditure we can claim when we will calculate income under the head income from house property. But as of now, these 4,000 should be disallowed because these 4,000 are not related to partnership firm's business. Okay. Now the next in the problem is donation. So here donation is given to unapproved trust. Now the next is provision for income tax, and after that there is a provision for bad debts. All these three all these three are not business expenditures. So these three should be disallowed and these three should be added back again in the in the net profit to find out the book profit, because these three are not business expenditures. So here I'll show you point number 5, 6, 7. As a point number 5, 6, 7, you will see these three are disallowed, and these three we will add back again in the net profit. Okay. Now the next in the problem is other operating expenses, and the figure is 12 lakhs. And I think there are two adjustments, adjustment number 4 and adjustment number 5. These two are related to these 12 lakhs. Okay. So according to adjustment number 4, out of other operating expenses, 40,000 are not deductible under the income tax law. It means income tax law has means the provisions of the act has disallowed this portion, that is rupees 40,000. And 5 is it includes 60,000 as a salary, and it is paid to domestic servant. So salary paid to domestic servant, but obvious it is not a business expenditure, so it should be added back. So we will add back again 40,000 and 60,000, which are a part of 12 lakh rupees, and these two are disallowed, and these two are not business expenditure, so we will add them back again in the net profit to calculate partnership firm's book profit. Okay. Now interestingly, there is a adjustment number 13. See what is shown, what is happened over here. In on assessment, it is found that the closing stock was undervalued by 290,000, and the opening stock was overvalued by 190,000. Okay, now interesting point to think. I'll give you a case. It will explain you what to do with these figures. So just assume that you just imagine in front of you there is a trading account, and the actual value of stock is 200 rupees. The actual value of closing stock is 200 rupees, and instead of showing it as a 200, intentionally it is recorded as 150. Now you tell me, you just imagine how will it affect the net profit figure of the business. Definitely, as because the closing stock figures affects the calculation of affects the calculation of profit, it will reduce now, because of this much undervaluation. Technically it will reduce the figure of profit, and intentionally it has been done here in the problem. So we will add back again this closing stock undervaluation in the net profit, and similarly intentionally opening stock was overvalued, and because of overvaluation of opening stock, the profit figure will be decreased because of the overvaluation of opening stock. So we will add back the opening stock overvaluation and closing stock undervaluation in the net profit. So undervaluation of closing stock 290, and overvaluation of opening stock 190. So 290 and 190. And in case of opposite scenario, suppose we have got here, suppose we were supplied with the figure of overvaluation of closing stock and undervaluation of opening stock. In that case, we would have deducted the same from the net profit below non-business income or disallowed income. Okay. So I think debit side is over. Debit side is over uh, because we have gone through all the accounting items given in the profit loss account. Now this part is over. Now the next part. Now we will check the credit side of profit loss account, and we will find out the non-business incomes which are recorded in the profit loss account on the credit side. And as these incomes are not the incomes under the head PGBP, we will deduct all such incomes which are recorded on the credit side of profit loss account, because right now we want to find out the book profit of a partnership firm. So we will consider pure business expenses and only pure business incomes. But the incomes which can be recorded or which are related to other heads of income like capital gain, other sources, house property, And if such a incomes are recorded on the credit side of profit loss account, then we will deduct the same under this particular point, because all these incomes are non-business incomes. Okay, now let's check the credit side. So the first thing is gross profit. It is don't uh, provide any treatment to this figure, because it is pure business profit, gross profit, and it is received either from trading account or the manufacturing account. Okay, but the next thing is interest recovered from Ram and Sham on drawings. So there might be few drawings, and on such a drawings the firm has recovered the interest. So this is pure income, business income of the firm. So it is not like non-business income. So it is not like disallowed income. It is totally allowable income, and it can be shown as income in the books. But the next thing is interest on debentures. Now, this firm has received 39,800, but it is non-business income and it is recorded on the credit side of profit loss account. We will deduct it. We will deduct it. So here, non-business income. Okay, we will deduct the same. We will deduct the same. The next is in the problem, rent of house property. Now, rent of house property is not business income. We should show it under income from house property, but it is recorded here in the profit loss account. It is not business income, so we will deduct it. We should deduct it. So deduct with me 50,000 rupees, two-third portion. Okay. Now, the next in the problem is interest on fixed deposit. Okay, it is also not business income. It should be shown under the head income from other sources. So let's deduct these 80,000 rupees under this point. So income from other sources, 80,000 rupees. Okay. Now the next is long-term capital gain on listed equity share and short-term capital gain on listed equity share. So these two are recorded on the credit side, but these two are not business incomes. These two are non-business income. So let's deduct the same from here as a point number 4 and as a point number 5. Okay. So long-term capital gain and short-term capital gain, their head is different. Their income head is different. That is capital gain. Okay, now the next is dividend. Dividend from Indian company, dividend from foreign company, 80,000 and 11,000. Now these two are not business income, these are non-business income, and these two should be shown under the head income from other sources. So let's show the same as a point number 6 and as a point number 7. Okay, so 80,000 and 11,000 under the head income from other sources. Okay, now the next in the problem is bad debts recovered. So in the past, the firm might have claimed that much exemption in the past as expenditure, but in the current tax year, this firm has recovered such a bad debts. So this is pure business income and it shouldn't be deducted again. It is pure business income. So don't consider it again in the tax computation. Okay, in the total income computation. Okay, but the next is short term capital gain on unlisted share and long term capital gain on unlisted share. Now these two by nature should be shown under the head capital gains, and the figure is 1 lakh 1 lakh, and these two are recorded here here in on the credit side of profit loss account. So let's deduct these two. Because these two are non-business incomes and their income head is different, that is capital gain. Okay, I think credit side. Now there are two more items: miscellaneous business income and commission from agency business. These two are business incomes, and as of now, means right now we are deducting non-business incomes credited on the credited in the profit loss account or recorded at the credit side of profit loss account. So credit side is also done. So now the next point is, now we will allow business expenses. Allowable business expenses means what? We will find out few business expenses, if any, in the adjustments. I mean to say, okay, I'll show you with example. For example, I think in adjustment number Adjustment number 12. So this firm has incurred advertisement expense and the value is 72,000 and the purpose is for business promotion and which have not been debited to the profit loss account. Now this expenditure is pure business expenditure, but as it is not recorded in the profit loss account, we should give the exemption, we should give the deduction for this expenditure in the calculation of book profit because it is not recorded in the profit loss account. And just like that, there is one more, this point number in adjustment number 10. There was outstanding GST liability relating to business expenditure of the previous year, but in the previous year it was disallowed because of the non-payment. But in the current year on 15 December 26, right now we are doing tax assessment for a tax year 26-27. So it means it is paid in the current year and it was disallowed in the previous year, and as it is paid in the current year, we can claim this deduction, and it is not recorded in the profit loss account at debit side. So we will deduct it here. Okay, because it is given in adjustment. Okay, now let's find out the book profit. Now how to find it out? It is very simple. What to do? First of all, in the amount of net profit, add all these disallowed expenses. So in 93 lakh 22,800, all disallowed expenses means from 50 lakh to 1 lakh 90,000. Add all these figures, and after this addition, deduct non-business incomes which we have recorded over here. Means from the previous total, deduct all these figures from 39,800 to 72,000. Deduct all these figures, and at the end you will get the book profit. So do the calculation and find out the book profit. I hope you have calculated it by pausing the video. Now the book profit is 1 crore 39 lakh 59,000. This is pure business partnership firm's business book profit. Okay, but it is not a taxable income. It is not a taxable income. Now the most interesting part, that is table 2. In table 2, we will compute total income of the firm, total taxable income of the firm. But how calculate it? First, calculate the total income from business, partnership firm's business. First, compute total income from partnership firm's business, and in that income, add income from other heads of income. Like if it has income from house property, then add in partnership, then add. If it has income from other sources, then add. If it has income from capital gains, then add. I mean to say, after adding other incomes from the heads of house property, capital gain, other sources in the partnership firm's business income, you will get that gross total income. And in the gross total income, if there are any deductions under chapter 8, if there are any deductions available under chapter 8, like section 133 donation section, then get the deduction, and then you'll get the total taxable income of the firm. Okay, now this here we will find the total taxable income of the firm. But as decided, first we will find out the income from the partnership business. Now, how to calculate it? Very simple. First, here in this table, first mention the book profit in the third column of amount. And as we already calculate the book profit in table 1, just get that figure and mention that figure here in the third column next to book profit. Now and always give, and now this column is important, computation logic. So give your attention for this column, computation logic. Now from the total of from this book profit, we will deduct allowable remuneration to working partner. And after deducting allowable remuneration to working partner from the figure of book profit, you will get what? You will get the figure of income from partnership business. Income from partnership business. And so we know the figure of book profit, but now we have to calculate the allowable remuneration to working partner. So here we have got 2 points. A point A, that is actual remuneration paid to working partner, and point number B, that is total statutory limit. So first let's find out point A and point B first. So point A is actual remuneration paid to working partner. So I'll go to the problem again. So in the problem, so there are three partners: Ram, Sham, and Subhadra. But out of these three, only Ram and Sham is working partner. And as per the provisions of income tax section 35, remuneration can be given only to working partner. Non-working partners shouldn't be given any remuneration. If it is given, then partnership firm cannot claim the same as a deduction. They cannot get the deduction for the remuneration paid to non-working partner. They'll get the deduction only for the remuneration paid to working partner. Okay, so Ram has been paid 20 lakhs as a salary. Ram has been paid commission rupees 2 lakhs. So in total he has been paid 22 lakhs, and Sham has been paid as a salary 30 lakhs and as a bonus 1 lakh. So in total he has been paid rupees 31 lakhs actually. So 22 lakhs to Ram and 31 lakhs to Sham. So 22 lakhs plus 31 lakhs is 53 lakhs. So in actual 53 lakhs remuneration is paid to working partner. Now we have to find out the statutory limit. So remuneration payable as per statutory limit. So let's compute remuneration payable as per statutory limit. Now there are three important provision. The provision one is related to business loss. I mean to say, whenever there is a book profit in negative, that time we have to consider the provision number one. I'll show you the provisions rather. I'll show you the provisions, and after showing the provisions, I'll explain you. So where it is? Here it is. So in when the book profit is negative, you follow this limit of rupees 3 lakh. But here in our case, the problem is not negative. Problem is positive. So instead of this provision, we will calculate we will calculate the total statutory remuneration as per these two important what I call provisions. So the first provision is on first 6 lakh of book profit, and the second provision is on the balance of book profit. So let's compute first on the first 6 lakh of book profit. Now the total book profit is 1 crore 39 lakhs 59,000. So the first 6 lakhs, for the first 6 lakh, this is the computation logic. So take the higher of rupees 3 lakh or 90% of book profit. So here we are considering 6 lakh rupees, first 6 lakh rupees of book profit. So 90% on 6 lakh. So just multiply this 6 lakh by 90%. So the limit is now 5 lakh 40,000, and we have to take the higher of 3 lakhs or 90% of book profit, that is 5 lakh 40,000. So higher between 3 lakhs and 5 lakh 40,000 is 5 lakh 40,000. So we will take here 5 lakh 40,000. Okay. Uh, Now the next limit is balance book profit. On the balance of book profit, we have to take 60 percentage. But we will have to calculate first balance book profit. Balance book profit. So the total book profit is 1 crore 39 lakhs 59,000. And just now we calculated, just now we considered first 6 lakh for first 6 lakhs. So just deduct the first 6 lakhs. You will get the balance book. So the balance it is 1 crore 39 lakhs 59,000. and we have to take 60 percentage of such a book profit. So just multiply this 1 crore 33 lakhs 59,000 by 60 percentage. So the figure is 80 lakhs 15,400. So take here 80 lakhs 15,400. Okay. Now total statutory limit. For the computation of a total statutory limit, just add these two figures, 5 lakh 40,000 and 80 lakh 15,400. I think the total is 85 lakh 15,400. Now we have got point A, 53 lakhs. A is actual remuneration paid to working partner, and we have got now B. So according to statutory limit, maximum remuneration payable to working partner will be 85 lakhs 55,400. But in order to calculate the income from partnership business, from book profit we have to deduct the lowest among point A and point B. The lowest is point A because A's value is 53 lakhs and B's value is 85 lakhs 55,400. So the lowest figure is A. So for the computation of income from partnership business, from the book profit, that is 1 crore 39 lakhs 59,000, deduct 53 lakhs because 53 lakhs is the lowest among two. Among A and B, 53 lakhs is the lowest. So, the income from partnership business after deduction, the income is 86 lakh 59,000 rupees. Now, after computing the income from partnership business, now we have to compute the gross income of the firm. Gross income of the firm. So, this firm has income under other heads also, like income from house property, income from capital gain, income from other sources. So we will show all such incomes one by one in any order, or for a better presentation you can do one thing. You first show the income from the head of house property, then show all the incomes under the head of capital gain, then income under the head of other sources. But what will I do? I'll just instead of following the order, all non-business incomes which we have recorded already, where in the first table, we will record all these non-business expenses, non-business incomes here in table 2 as a income from other sources. And I'll follow the same sequence. Okay, so the first is what? Interest on debentures. I'll just make the character bold. So 39,800, I'll show the same first, and there is no other adjustment now. There is no hidden adjustment for this particular source. So 39,800. So 39,800. Okay. Now the next income is interesting. So it is rent, no? Okay. And the total rent is 50,000. But if you could remember, there was an adjustment, that is, ground floor is used for business purpose, first and second floor is let out, and the total municipal tax on the entire property is 6,000, out of which 4,000 we disallowed. No, look here, which we disallowed because this 4,000 cannot be shown as a business expense, and this 4,000 we can easily relate with this against the income from house property. So 50,000 is the gross income from the house property, but it is not the net income from the house property. So from 50,000 we will deduct first 4,000, and after deducting 4,000, we will also charge general deduction of 30%. So what to do? On your calculator, first type 50,000, then press the button of minus, then press 4,000, and then again press the button of minus, then press 30 and then press the button of percentage. You will get what? The net taxable income under the head income from house property, that is 32,200. Okay, I'll show you how to do it. First press on calculator 50,000, then press the button of minus, then press 4,000, then press minus, then 30 and then percentage. You will get this figure only. If you don't like calculation the way I just explained you, there is one more way. What to do? First from 50,000 deduct 4,000, then the balance will be 46,000, then charge 30%, then calculate 30% on 46,000. So 46,000 into 30 percentage, 30 percentage is the standard deduction. Mm, then what to do? Then the balance income. So 46,000 minus 13,800. Balance income is 32,200. The income is same. So two methods I just explained you to compute the taxable income under the head house property. Okay. Now the next in the problem is okay. The next in the sequence is what? Interest on fixed deposit, then long-term capital gain, short-term capital gain, dividend from Indian company, dividend from foreign company, short-term capital gain, long-term capital gain, all business expenses, all, so not expenses, incomes, all non-business incomes, which we deducted in the table 1, that is computation of a book profit under the head less non-business incomes. We will record all these again here in table 2, and here we deducted in table 1, in table 1, but in table 2 we will add all these incomes. We will add all these incomes the way we added interest on debentures and rent from house property, but under their income heads. But under their income heads. I'll show you. I'll show you. Look here. Uh, Under their heads. Okay. Okay, look. So interest on fixed deposit, long-term capital gain on listed equity share, under the head long-term capital gain, short-term capital gain on listed equity share, under the head short-term capital gain, dividend, under the head income from other sources, short-term capital gain, long-term capital gain on unlisted shares, under the head capital gain, short-term capital gain and long-term capital gain. I just repeated. So in table 1 we deducted, in table 2 we will add, but only thing which we not added as it is the income from house property, and that is rent from house property, because we claimed the deduction of 4,000 as a municipal tax, and on the balance we charge general deduction of 30%, and the balance is the net taxable income under the head house property. Now there is adjustment. There is one interesting adjustment in the problem. I think adjustment number is 7. Okay, 7. Look, adjustment number 7 is interesting. This firm in current tax year sold urban land for 2,20,000, and the index cost of acquisition is only 1 lakh. So it has sold this land in profit. So there is a, if you take a difference between this 2,20,000 and 1 lakh, the difference is 1,20,000, and this is income, but income under the head capital gain. But now we have to decide whether it is short-term capital gain or long-term capital gain. And if you see the date of or the year of purchase, then the year of purchase is 1920. 1920. So technically, it is the property is urban land. The period is more than 24 months. 24 months. That's why the gain is long-term capital gain. Now, one more interesting thing. You check the credit side of profit loss account. Is that gain mentioned? Is that get mentioned on the credit side of profit loss account? No, it is not mentioned. As it is not mentioned on the credit side of profit loss account, when we deducted non-business incomes in the table 1, in the table 1, here you will not find this capital gain on urban land, because it wasn't shown on the credit side of profit loss account. And in the table 1 we added back all non-business incomes, right? But here it is not deducted here in table 1, but in table 2 we should show this as a income under the head capital gain, because it is a income. It is a income under the head capital gain. So don't be confused. Don't be confused for this particular adjustment, and don't do not make a assumption, as it is, though it is not mentioned in the on the credit side of profit loss account. So we will not mention it as a income in table 2, where we are computing right now total taxable income of the firm. This is the taxable income of the firm, so it should be shown over here. Okay, so add long term capital gain on sale of urban land under the head long term capital gain, and the figure is 1,20,000. Okay, and again I'm again I would like to explain. So here in table 1, when we were deducting non-business income, we are supposed to deduct only those non-business incomes which are credited to profit loss account. I mean to say, which are shown on the credit side of profit loss account. Only such a non-business incomes we are expected to deduct. Okay. Now the next is, now we have to find out the gross income of the firm. Now in the gross income of the firm, I mean to say, in the partnership firm's pure business income, that is 86 lakh 59,000. We will add all these. We will add all these incomes. This firm received under the other heads of incomes, like income from other sources, short term capital gains, and income from house property. So in short, make addition of all these figures from 86 lakh 59,000 to 1 lakh 20,000. Make addition. You will find the you will get the figure for gross income of the firm. Therefore the income is now, total gross income is 1 crore 9 lakhs 11,000. But this is not the taxable income of the firm, because under chapter 8 we can claim one deduction. I'll show you the notes first. So here, look, we just now calculated the gross total income, but under chapter 8 we can claim deduction. For example, under section 133, claim for donation, if it is made to certain approved charitable institutions, funds, trust, other eligible institution, then it can be claimed. Its deductions can be claimed. Now in the problem, there is a deduction which we can claim under section 133, and the adjustment number is 11. Look, this firm donated rupees 2,11,000 to PMNRF fund, and 100% exemption can be claimed under section 133. So from the gross total income, claim the deduction for this donation made towards this PMNRF fund, and from gross income of the firm, deduct this 2,11,000. You will get the total income, total taxable income, and the total taxable income is 1 crore 7 lakh. So this firm's taxable income is 1 crore 7 lakh, and we will very soon, after table number 3, compute tax on this taxable income 1 crore 7 lakhs. But before that, just go through the adjustment and see whether we have left any adjustment. So part, the adjustment number 1 and 2 is, these are just basic adjustments which allows us to do tax calculation and total income computation. Okay, so we have already considered all the adjustments. Now it means there is no adjustment left, there is no particular left to be considered for the computation of total taxable income. Okay, now table number 3. Now table number 3 is interesting. In table number 3, we are supposed to compute. So what portion of the firm's income is taxable in the hands of partner? So these are three partners, right? Ram, Sham, and Subhadra. So the first of all, I'll begin with the uh, simple thing, that is share of profit. So share of profit received from the partnership firm to partner is exempted in the hands of partners. Okay, I'll give you example. Let's say the profit before tax is 1 crore, and after the payment of tax, let's say the remaining profit is 70 lakhs, and this 70 lakhs profit is distributed among the partner. Just assume that among the partner. So again, partner, there is no need to pay tax again, because the tax is already paid by the partnership firm, and after the payment of tax, profit is distributed among the partners. So such a profit is exempted from tax in the hands of partner. Now these two partners also received what? The salaries and the remuneration and interest on their capital. Now I'll explain this point first. Interest on partners capital allowed up to 12%. We know that the partnership firm can claim any interest payment on capital up to 12% if it is allowed by deed. And here in the problem, the ram has been paid interest at the rate of 12% only, and that much deduction the partnership firm has claimed that much deduction of 1,20,000. So if the deduction is claimed by the partnership firm, this is important. I am making an important statement. If the partnership firm has claimed any deduction, if it is allowed to be claimed as a deduction according to the income tax rules, then such a portion in the hands of partner is income, but it is and up to this uh, and it is taxable in their hand, and up to that much portion it is taxable in the hands of partners, because the partnership firm has a claimed deduction on it, right? So ram, as ram has already paid, so 1,20,000, up to 12% is allowed. But in case of a sham, look, sham has been paid interest at the rate of 18%, and up to 12% interest expenditure can be claimed. So extra 6% we added back now in the net profit. So 12% is allowed. So if it is allowed in the books of partnership firm, then it is taxable in the hands of partners. So out of 1,80,000, that 6% portion was 60,000. So 60,000 was disallowed, and that was added back in the first table. It means remaining 1,20,000 is allowed now. Remaining 1,20,000 is allowed, and that is taxable in the hands of Sham. So 1,20,000. Now in case of Subhadra, she has been paid interest at the rate of 27%, and in total 2,70,000, and up to 12% is allowed, and excess 15 percentage, which was 1,50,000. You check the table 1 where we calculated the excess percentage. So 1,50,000 was disallowed. It means what? 1,20,000 was allowed, and any portion of interest which is allowed is taxable in the hands of partner. So in the hands of Subhadra, 1,20,000 is taxable. Now, as far as remuneration is concerned, Subhadra was non-working partner, and to non-working partner, non-working any salary, commission, bonus, I mean to say remuneration in the form of salary, bonus, commission. If it is paid to non-working partner, then partnership firm cannot claim deduction. If partnership firm cannot claim deduction, then it is not taxable in the hands of Subhadra. It is not taxable in the hands of partner. So here in the case of Subhadra, it is not taxable, because partnership firm cannot claim deduction for remuneration given to non-working partner. But to Ram and Sham were working partners, and partnership firm has claimed deduction for Ram's remuneration and for Sham's remuneration. If you want to cross check, you can go to the table 2 again. So in table 2 here you will find this 53 lakhs rupees exemption, 53 lakhs exemption deduction the firm has got. So it has got the deduction, it has claimed the deduction, so it is taxable in the hands of Ram and Sham. So Ram was paid, I think, 20 lakhs rupees salaries and 2 lakhs rupees bonus or commission, I'll check just a minute. So Ram was given salary 20 lakhs, okay, and he was also given a commission, so 2 lakhs. So 22 lakhs are taxable in the hands of partner because the firm has claimed 22 lakhs deduction. So 22 lakhs I'll show over here as a deduction. Okay. And in case of Sham was given salary 30 lakhs, and he was also given what bonus. Okay, 1 lakh. So 30 plus 1, 31 lakhs deduction partnership firm claimed. If partnership firm has claimed deduction, then it is taxable in the hands of what Sham. So 50 31 lakhs. Now you might say you must have a problem, you must have a question. Subhadra was also given a remuneration, but why not Subhadra? And Subhadra has received remuneration technically, but why not it is taxable in the hands of Subhadra? The answer is very simple, because in the partnership firm tax assessment, the partnership firm has not received deduction or has not claimed deduction for the remuneration paid to the Subhadra. And as it has not received the deduction, its income uh, increased, right? Its income has been increased, and on its increased income, it will pay flat income tax at the rate of 30%. And there is no double taxation is not allowed. That's why Subhadra is free from paying any tax, though it has received what a remuneration from the partnership firm. So now we will calculate the total taxable income in the hands of partner. So in case of Ram, it is 23 lakhs. Of Sham, it is 32 lakh 20,000, and in case of Subhadra, it is 1 lakh 20,000. It means Ram will pay tax on 23 lakhs 20,000. Sham will pay tax on 32 lakhs 20,000, and Subhadra will pay tax only on 1 lakh 20,000. Now the table number 4, the most important part of the problem. Now here we will calculate the total tax to be paid by this partnership firm. Now the total income is what? 1 crore 7 lakh. So on 1 crore 7 lakh, this firm should pay income tax. But these 1 crore 7 lakhs includes incomes under different heads. Like it includes income under head long-term capital gain, short-term capital gain, income from other sources, and income from house property and partnership firms business income. And there are few incomes which has got rate of income tax. Special rate of income tax. For example, short-term capital gain on listed equity share, the rate is 20 percentage. Rather, I'll show you the list in the notes. Here only you will see the list. So according to the list, where is the list? Here it is. So look. So in case of tax on short-term capital gain, if it is listed equity share, and if it is held for a period of less than 12 months, it could be listed equity shares or equity oriented mutual funds. But according to section 196, the rate of tax is 20%, the flat rate 20%. So here in the problem, there is what short-term capital gain, listed equity short-term capital gain. I'll make it bold. And on this 3 lakh rupees, we should pay tax at the rate. I mean, this firm should pay tax at the rate of 20% under section 196. So here I'll mention this thing first. Short-term capital gain. The total income is 3 lakhs. 3 lakhs. So 3 lakhs, and the rate of income tax is 20%. So 20% on 3 lakhs. You just type 3 lakhs on calculator. First type 3 lakhs, then press a button of multiplication, then press a button of 20, and then directly press a button of percentage. You will get this figure. So 60,000. Okay. Now the next income is next special income is okay. I missed it. I missed this income. I'll take it now. Okay. By the way, interest on debenture, rent from house property, interest on fixed deposit, these three are not, these three have no special rate of income tax. But long-term capital gain on listed equity share, it has got special rate of income tax. I'll show you, but I'll make it bold first. Okay, now check the rate. So section 198. Section 198. It is for tax on listed equity and long-term capital gain. So according to this section, the rate of income tax is 12.5 percentage. But there is a limit. There is exemption limit. Only the amount in excess of 1,25,000 is taxed. It means any long-term capital gain on listed equity share, if it is below, if it is less than the exemption limit, that is rupees 1,25,000, is tax free. Is tax free. But any income, if there is income in excess of 1,25,000, then only that much portion is taxable at the rate of 12.5 percentage. I will show you. Okay, what is the total long term capital gain? 3 lakh. Okay, and what is the exemption limit? 1,25,000. So what to do? Take the difference. What is the difference? From 3 lakhs, deduct 1,25,000. So because 1,25,000 exemption limit is there. So the balance income is 1,75,000. On this balance income, that is 1,75,000, it is excess income over 1,25,000. So on 1,75,000, charge 12.5 percentage. So calculator first type 1,75,000, then press a button of multiplication, then press 12.5 and directly press the button of percentage. You will get the tax on long term capital gain on listed equity share, and the tax will be 21,875. Okay. Now, what is next? Is there any special rate income? Now, dividend and dividend. Okay, these two don't have special rate of income tax, but the short-term capital gain on unlisted share. I'll make it bold first. I'll show you the section, and it is unlisted share. On unlisted share, it has got gain, that is short-term capital gain, and the amount is 1 lakh rupees. But I'll show you. Here, see this point. Short-term capital gain from unlisted asset like land, building, gold, unlisted share. If it is held for a period less than 24 months, though there is no concessionary rate, but they are treated as a regular business income, and they are taxed at a standard flat rate of 30%. So charge 30% directly here. So short-term capital gain unlisted shares 30%. So 1 lakh, 30% on 1 lakh is 30,000. So charge 30,000. Okay. So 30,000. Okay. Now the next in the data is in the income list is long-term capital gain unlisted shares. Okay, I'll make it bold first. I'll show you the section number 197 if I'm not wrong. So long-term capital gain on unlisted shares, land, buildings, gold, etc. held for more than 24 months. Then the tax rate is 12.5%, but there is no exemption limit. See, in section 198, in case of listed equity share, there was exemption limit of 1,25,000, but in section 197, there is no exemption limit. It means tax applies from the first rupee. So on entire amount pay tax at the rate of 12.5 percentage. Now what is the total income? Total income is 1 lakh. So on 1 lakh 12.5 percentage. So long term capital gain unlisted share, so 12,500 will be the answer. Yes, 12,500. Now, are there any other income? Yes, there is one more income, that is long-term capital gain and sale of urban land. And just now we read section 197, so we will apply 197 for the payment of tax on the long-term capital gain, that is 1,20,000. So again, at 12.5 percentage, so 12.5 percentage on 1,20,000, so 15,000 rupees tax is payable. Now, now we will pay tax. We will pay tax on the remaining income. We will pay tax on remaining income. But for that, we need to calculate first remaining income. Okay, how to calculate it? What is our total income? Our total taxable income is 1 crore 7 lakhs, right? 1 crore 7 lakh. It means we are supposed to pay tax on 1 crore 7 lakhs. But just now we calculated tax on these 3 lakhs long term capital gain, then on these 3 lakhs short term capital gain, then we calculated tax on the short term capital gain on unlisted shares, then long term capital gain on unlisted shares, then long-term capital gain on sale of urban lands. So we already calculated tax now on this on these much values. So for the balance for the remaining income, what to do? From the total income, that is 1 crore 7 lakhs, deduct all these figures on which we just calculated tax. So these 3 lakhs first, then these 3 lakhs, just a minute. 3 lakhs, 3 lakhs. Then again I made a same mistake. Okay, array. Uh, then this 1 lakh, then this 1 lakh, and then this 1,20,000. Okay, therefore the balance income is 97 lakh 80,000. On there is one more way. Just make addition. 3 lakh plus 3 6, 6 plus 1 7, 7 plus 1 8, 8 plus 1 9. So 9 lakh 20,000. From 1 lakh 7,000 deduct 9 lakh 20,000, you will get this figure only, 97 lakh 80,000. So this is the figure of remaining balance income, 97 lakh 80,000. And on 97 lakh 80,000, we are expected to pay tax at the rate of 30%. We means this firm is expected to pay tax 30%. So let's calculate 30% on 97 lakh 80,000. So is equal to 97 lakh into 30 percentage into 30 percentage. So 29 lakh 34,000. So 29 lakh 34,000 is the tax on remaining income. 29 lakhs 34,000. Now make a total of all these taxes to find out total basic, to calculate total basic tax. Make a total of all these taxes. So total is 30 lakhs 73,375. Now we will calculate surcharge. Now this firm will have to pay a surcharge because this firm has crossed the threshold limit, and the threshold limit is 1 crore. I mean to say, if the total income, in the case of this problem, the total income is 1 crore 7 lakh, and the total income is more than 1 crore. That's why surcharge is applicable, and the rate of surcharge is 12%. But only thing is, don't compute surcharge on the total income. Compute surcharge or calculate surcharge on total basic tax. I mean to say 12% on 30 lakhs 73,375. Calculate and mention. Therefore, the calculation is 3,68,805. Total surcharge is 3,68,805. Now add surcharge in the total basic tax. So make an addition of these two figures, 30,73,375 plus 3,68,805. Okay, therefore the total is now 34 lakhs 42,180. Therefore, tax after surcharge is 34 lakhs 42,180. Okay. Now, whenever there is a surcharge and surcharge is because of threshold, threshold word is important. Huh? Threshold word is important. So, whenever there is a surcharge because of threshold, we should make calculations for marginal relief. So marginal relief in the payment of tax, whether it gets the relief in the payment of marginal relief in the payment of tax or not, we need to make a calculation for this. Now, I will give you a situation. I'll give you a situation. Just assume that the partnership firm's total income is only 1 crore. Here in the problem it is 1 crore 7 lakhs. But just assume that but the partnership firm's income is only 1 crore, right? Is only 1 crore. Now, in that case, will be there any need to calculate? Will be there any need to charge surcharge? Because the total income is only 1 crore, and if income it crosses the limit of 1 crore, then only it will have to pay a surcharge, right? But here in the problem, the total income is more than 1 crore, right? That's why there is a surcharge. But because of payment of surcharge, is there any need to calculate the marginal relief? As far as this problem is concerned, there is no need to calculate the marginal relief. I will tell you why. Okay, okay, you tell me how much income is in excess over 1 crore? The answer is 7 lakh. My question was how much income is in excess of 1 crore? The answer is 7 lakhs. Now, here in the problem, how much additional tax is tax is added on account of surcharge? The answer is only 3,68,805. The answer is only 3,68,805. So in this case, the additional income over 1 crore is much more than the additional tax in the form of surcharge, because the additional income was 7 lakhs na over 1 crore, and surcharge is only 3,68,805. So additional income over 1 crore is more than the amount of surcharge. That's why there is no need to calculate the marginal relief. There is absolutely no need to calculate the marginal relief. And in the exam, I'll advise you if the extra income over threshold limit is more than the figure of surcharge, then there is no need to calculate the marginal relief. Absolutely no need to calculate the marginal relief. But in order to explain you how to compute the marginal relief, I'll compute here, but I give you I know 100% the marginal relief answer will be zero, because additional income over 1 crore is 7 lakh, and additional tax because of surcharge is only 3 lakh 68,805, and additional income over 1 crore 7 lakh is much more than 3 lakh 68,805. Therefore the marginal relief will be zero. But just to explain you, I'll calculate it again. So the step number 1 is simple. But before that, step number 1 is simple. What is step number 4? That is step number 1, sorry, that we have to mention the actual tax liability after surcharge and before marginal relief. So this figure which we calculated just now, we will mention over here. Okay, then in step number 2, we will reduce the total income of the partnership firm up to rupees 1 crore, and keeping the special rate income as it is. While keeping the special rate income as it is, I think the total income was 1 crore 7 lakhs. So I'll just make few changes here first, because the total income was 1 crore 7 lakhs. So here 7 lakhs, and that income we will reduce by 7 lakhs to make it 1 crore, and while keeping the special rate incomes as it is. Okay, now what to do? Okay, we cannot make a change in what special rate incomes. All these special rate incomes, we will consider all these special rate income as it is. We will consider all these special rate incomes as it is. Okay. So take all these incomes as it is first. Okay. Hmm? And their tax won't change. So tax will remain the same, no, because we are not changing the income. Now we will make a addition of the income of all these. We will make a addition of actual income of all these figure of all these incomes. So we already so in table one, here in table one, so all these are special rate incomes, right? So 3 plus 3 is 6 lakhs, 6 plus 1 7, 7 plus 1 8, 8 plus 1 9 lakh 20,000. And so 9 lakh 20,000 is the addition of special rate incomes. So 9 lakh 20,000. So what I'll do in order to calculate the balance income, in order to calculate the remaining income from a total of 1 crore, because here we are assuming our income is only 1 crore. 1 crore, I'll deduct all these special rate incomes, and the total of all the special rate incomes is 9 lakh 20,000. So the income is now 90 lakh 80,000, and on 90 lakh 80,000 we will calculate tax at the rate of 30%. So 90 lakh 80,000 into 30 percentage, 30%, the answer is 27 lakh 24,000. So 27 lakhs 24,000. Okay. Now the total, we will do now the total from 21,875 to 27 lakh 24,000. The total is now here 28 lakh 63,375. Now, in step 3, we will calculate how much tax is increased due to surcharge. So, it is very simple. So, as per step number 1, our tax was 34 lakhs 42,180. Look here, our tax was 34 lakhs 42,180. But as per step 2, if the income considered is only rupees 1 lakh, then as per step 2, the tax is only 28 lakh 63,375. So total increase in tax due to surcharge is now 5 lakh 78,805. 5 lakh 78,805. And if you compare this increase with increase in income over 1 crore, now increase in income over 1 crore is 7 lakhs. 7 lakhs. So if you compare that increased income in excess of 1 crore with the surcharge, then income over 1 crore is more than increase in tax due to surcharge, right? So there is no need to give marginal relief. We would have given marginal relief in case of opposite scenario. I mean to say, tax increase in tax due to surcharge is more than excess income over 1 crore. In that case, we would have given marginal relief and we would have done the calculation for marginal relief. But as far as this problem is concerned, there is no need to provide marginal relief. And in exam, actually all these calculations are you are not expected to do, provided provided you are 100% sure that there is no need to provide marginal relief, and you can frame means you can have this confidence if you compare, if you know that excess income over 1 crore, that is in case of this problem is 7 lakhs, and this 7 lakh is more than the amount of surcharge, then you can show directly that marginal relief is zero. There is no need to there is no need to make any computation for the marginal relief, because excess income over 1 crore, excess income over threshold limit is more than the amount of surcharge. Okay, but as I said, I wanted to show you, that's why I did the calculation for marginal relief. So marginal relief here it is zero, so tax after marginal relief will remain the same. Now we have to calculate the 4% health and education cess, and it is on the figure of tax after marginal relief. So 4% on 34 lakhs 42,180 is 1 lakh 37,687. So on 34 lakhs for 42,180, charge 4%. Charge 4%, and the figure is 1 lakh 37,687. Then make a total of these two, and the tax is 35 lakhs 79,867. We should round it off closest to 10. So under section 516, let's round it off nearest to closest 10. Nearest closest 10 is 70. So 35 lakhs 79,870 is the final figure, final tax payable figure. So this firm should pay 35 lakhs 79,870 as a tax on its taxable income. So this is the problem. I think I have covered everything. I have tried to explain as much, as many provisions related to this particular topic. So, chalo, thank you. Bye bye. And try to solve this problem on your own.